The ICE fund returned 5.1% for the September quarter and 4.3% for the rolling year to the end of September, net of fees. August featured reporting season, and within that, the profit results for the ICE fund at large. We measure the median earnings per share or profit growth of stocks in the portfolio at just over 12%, a really healthy profit growth for the companies that the ICE portfolio invests in. We are benchmark unaware, and we would highlight that the small cap industrial segment, the closest comparator to our fund, returned 11.2% for the quarter and 12.9% for the year. So while it's pleasing to see small companies return to favour and outperform their large cap peers, we do note that the fund did lag the performance of the small industrials index. So why was that? Well, again, pleasingly, we noted the performance of the small cap segment, but we would highlight how narrow the contribution to this return was. In fact, 9 stocks that contribute to the small industrials contributed nearly 60% of this return for the calendar year. So what we're seeing is a number of stocks are being left in the shade with quite a bias to our portfolio. So the positive there is that we see a lot of scope and a lot of juice within the stocks that we own. We had some excellent results for the August reporting season, and these tend to drive share price returns for the quarter. The first was Baby Bunting, a retailer in Australia with 40% market share of the baby goods category. We've followed this company for some time and not invested. We didn't believe it was well managed, and we didn't believe they could build a moat which would see Baby Bunting become a true category killer in its segment. However, new management, who've been there nearly 2 years, have demonstrated some profound improvement across their retailing footprint. Improvements to gross margin, improvements to store layout, improvements to buying and supplier deals, and improvements to the look and the feel in the store, which are really driving those young parents into shop. Baby Bunting returned nearly 70% for the quarter, noting that we invested earlier this year. The second key driver was AP Eagers, auto retailer in Australia, and noting that the company has recently expanded its footprint and now includes a retail presence in the Canadian auto market. AP Eagers do act like a category killer in their space. Their efforts to modernise retailing by aggregating dealer brands on one side, productivity improvements, and record levels of sales per car dealer continue to drive a higher than above profit margin for this company. AP Eagers has several growth drivers. These include its retailing footprint in second-hand cars, Easy Auto 123, its offshore potential, and again, the margin improvement which the category are targeting. Both of these stocks are examples of franchises that are looking to leverage their footprint, expand their market, and grow their profits. The ICE portfolio holds a basket of franchises with an economic moat. That's been our strategy since day one. We look for these companies to grow profits at a very strong clip. Within the top 5 stocks we own, I'd call out 2 names. Port of Tauranga, New Zealand's largest deepwater port. This is the port that can take the biggest boats into New Zealand. Its asset is obviously its landmass. Port of Tauranga fully own the port facility, and 2 things have begun to occur in recent times. Firstly, Port of Tauranga is exercising its pricing power, putting up prices to shipping lines and customers. And secondly, Port of Tauranga is seeking to gain market share against Port of Auckland, which itself faces capacity constraints. So as a franchise growing market share and growing profits, we see strong potential for this business. The second company I'd call out is Catapult, Sports Performance Technology. Catapult have wearables and video device which support elite teams across the world. They've been winning business at an impressive rate across new sports, across existing sports, winning lots of sporting teams in women's sports and expanding geographically, Asia, South America and more. For sports performance technology and every human's willingness to want to measure themselves and do better, we think this journey is only starting. And we note that Catapult recently have acquired another business in the space specialising in soccer or world football. So what positions are new to the fund in the quarter? We believe that Qoria are now the leading player globally in protecting children within schools. Their technology is a software filtering process supported by an online capability which provides alerts to parents where children are at risk of harm. It's a hugely important concept. And again, the company's presence in America, UK, Australia is expanding, and they're now thinking like the category leader. The fund took profits in several names: APE Eagers, which I've mentioned, Temple & Webster, and Catapult, which I've also mentioned. So why should you invest in the ICE portfolio today? Firstly, we can see that investor interest in small caps is returning. Secondly, and where we have in the past on 3 occasions seen the ICE performance lag that of the small cap industrials to this extent, on each of those 3 occasions, we've seen that performance gap recover in 14 months, 4 months and 9 months on each occasion. The profit growth of the ICE stocks within reporting season highlighted 12% median earnings per share growth. And yet on a rolling year basis, the total return net of fees for the fund was 4.3%. As interest in small caps returns, and this broadens across the small cap universe, we believe our investments are really well positioned to capture this interest, and hence why we think you should be considering an investment in ICE today.
This fund update has been prepared by SG Hiscock Company to provide general information only and is not intended to take the place of professional advice, and it does not take into account the investment objectives, financial situation or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.